Welcome to a journey that could change your financial future. Did you know that nearly 70% of Americans feel insecure about their retirement savings? Or that only 30% of individual investors beat the market each year? These numbers might shock you, but they highlight the importance of a well-crafted investment strategy. In this video, we will uncover the secrets to creating a bulletproof investment portfolio. You'll learn how to diversify like a pro, discover hidden investment gems, and manage risks effectively. We'll explore the debate between active and passive investing and show you how to build a multi-layered income system. Plus, we'll dive into future trends that could skyrocket your returns. By the end, you'll have the tools to make smarter investment decisions and secure your financial future. Whether you're a seasoned investor or just starting, these strategies will give you the edge you need. Ready to transform your portfolio and your life? Let's get started. Chapter 1. The Foundation. Rock-solid diversification strategies. Building a solid investment portfolio starts with smart diversification. But what does that really mean? Think of your portfolio as a sturdy house. Diversification is like using different materials to build it. You wouldn't want a house made entirely of wood. You'd mix in some steel and concrete. Similarly, you don't want a portfolio made up of just one type of asset. Diversifying across asset classes is key. This means investing in stocks, bonds, real estate, and even commodities. Each asset class reacts differently to market conditions. For instance, when stock markets fall, bond prices often rise. By holding a mix of assets, you reduce your risk. Did you know that during the 2008 financial crisis, gold prices soared by over 25%? While stocks plummeted, gold acted as a safe haven. This is why having a portion of your portfolio in commodities can be wise. It's not just about spreading your money around, it's about choosing the right mix. A study by Vanguard found that a diversified portfolio of 60% stocks and 40% bonds provided better long-term returns with lower risk compared to portfolios concentrated in a single asset. Diversification isn't a new concept. Harry Markowitz, a Nobel laureate, said, "Diversification is the only free lunch in investing." Besides asset classes, consider geographic diversification. Investing in international markets can protect you from domestic downturns. For example, while the US market struggled in the early 2000s, emerging markets like China and India showed significant growth. Sector diversification is another layer. Within stocks, don't just invest in tech. Look at healthcare, consumer goods, and energy. Each sector has its own cycle. When tech stocks fell during the dot-com bubble, consumer staples like Procter & Gamble remained stable. It's also smart to include both growth and value stocks. Growth stocks are like the hares of the market, offering high returns but also higher risk. Value stocks are the tortoises, providing steady, reliable returns. Balancing both can lead to more stable growth. Remember to rebalance your portfolio regularly. Over time, certain investments will outperform others, throwing off your desired mix. By rebalancing, you bring your portfolio back in line with your goals. A report from Morningstar found that portfolios rebalanced annually performed better over time than those left untouched. Chapter 2. Hidden Gems. Uncovering underrated investment opportunities. Now, let's uncover some hidden gems. These are investment opportunities that often fly under the radar but can provide significant returns. Think of them as the treasure chests buried in the sand. You just need to know where to dig. Start with small cap stocks. These are companies with a market cap between $300 million and $2 billion. They're often overlooked by large institutional investors but can offer substantial growth potential. According to a study by Ibbotson Associates, small cap stocks have historically outperformed large cap stocks, averaging annual returns of 12% compared to 10% for large caps. Next, consider emerging markets. These are economies transitioning to more advanced stages of development. Investing here can be risky, but the rewards can be great. For instance, from 2000 to 2010, the MSCI Emerging Markets Index had an average annual return of 10.1%, compared to just 1.4% for the S&P 500. Another hidden gem is real estate investment trusts, REITs. REITs allow you to invest in real estate without owning property. They can provide high dividends and are less correlated with the stock market. NAREIT, the Association for REITs, reported that from 1972 to 2019, REITs had an average annual return of 11.8%. Don't forget about peer-to-peer lending platforms. These platforms allow you to lend money directly to borrowers, cutting out the bank as the middleman. According to Lending Club, their investors have earned an average return of 5.06% since 2008. It's a way to generate income that's not tied to the stock market. Art and collectibles can also be a unique investment. The Art Market 2020 report found that global art sales reached $64.1 billion, with online sales doubling in volume. While it's not for everyone, investing in art can diversify your portfolio and offer the potential for high returns. Finally, consider green energy stocks. With the world moving towards sustainable energy, companies in this sector are poised for growth. According to the International Energy Agency, renewable energy capacity is expected to expand by 50% between 2019 and 2024. Investing in companies focusing on solar, wind, and other renewable sources can be a profitable long-term strategy. Remember, finding hidden gems requires research and a bit of risk tolerance. But the potential rewards make it worth the effort. Diversifying into small caps, emerging markets, REITs, peer-to-peer lending, art, and green energy can give your portfolio an edge. These opportunities may be less conventional, but they can provide substantial growth and stability. In the end, a bulletproof portfolio is not just about the usual suspects. It's about exploring the less obvious, digging deeper, and finding those hidden gems that can truly set your investments apart. Chapter 3. Risk Radar: Proactive Risk Management Techniques. Managing risk is like being a vigilant radar operator, constantly scanning for potential threats. It's not about avoiding risks altogether but knowing how to handle them. The first step in risk management is understanding your risk tolerance. This is personal and depends on factors like age, financial goals, and investment timeline. Once you know your risk tolerance, you can allocate your assets accordingly. For example, younger investors might lean more towards stocks for higher growth, while those nearing retirement might favor bonds for stability. The classic 60-40 split between stocks and bonds is a popular strategy, but it's not one size fits all. Hedging is another powerful tool. This involves making an investment to offset potential losses in another. For instance, if you own stocks, you might buy put options. A put option gives you the right to sell a stock at a certain price, acting like an insurance policy. During the 2020 market crash, those with put options saw far fewer losses. Diversification, which we've discussed, is also a key risk management strategy. By spreading investments across various assets, you reduce the impact of a poor performance in any one area. Remember the old saying, don't put all your eggs in one basket. Another strategy is using stop-loss orders. This is an order to sell a security when it reaches a certain price, preventing further losses. For example, if you buy a stock at $50, you might set a stop-loss order at $45. If the stock price falls to $45, your shares are automatically sold. This can save you from more significant losses. Risk management also means keeping an emergency fund. This is money set aside for unexpected expenses or financial emergencies. A general rule is to have 3 to 6 months' worth of living expenses saved. This ensures you won't have to sell investments at a loss during a downturn. Regularly reviewing and rebalancing your portfolio is crucial. Over time, the performance of your investments can shift your portfolio's balance. By rebalancing, you realign your investments with your risk tolerance and goals. A study by T. Rowe Price showed that rebalancing annually can enhance returns and reduce risk. Understanding market cycles is another part of proactive risk management. Markets move in cycles, with periods of growth, bull markets, and decline, bear markets. Being aware of these cycles helps you make informed decisions. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." Consider the geopolitical landscape as well. Political events can have significant impacts on markets. For example, trade tensions between the US and China in recent years have caused market fluctuations. Staying informed about global events can help you anticipate and manage risks. Chapter 4. The Tactical Playbook: Active versus Passive Investing. The debate between active and passive investing is like a chess match, with each side having its own strategies and advantages. Let's dive into this tactical playbook and explore how you can blend both approaches for a winning portfolio. Active investing involves hands-on management. Here, investors or fund managers make specific stock picks and market timing decisions. The goal is to outperform the market. This approach requires deep research, analysis, and often, a bit of gut feeling. Legendary investor Peter Lynch once said, "Know what you own, and know why you own it." Passive investing, on the other hand, is about tracking the market. Instead of trying to beat the market, passive investors aim to match its performance. This is usually done through index funds or ETFs, exchange-traded funds. These funds replicate the performance of a specific index, like the S&P 500. According to Vanguard, over 80% of actively managed funds underperformed their benchmarks over the past decade. Costs are a big factor in this debate. Active funds often have higher fees due to the research and trading involved. In contrast, passive funds typically have lower fees. Morningstar reports that the average expense ratio for passive funds is 0.12%, compared to 0.62% for active funds. Lower fees mean more of your money stays invested. Active investing can shine in volatile markets. Skilled managers can adapt to changing conditions and seize opportunities. For example, during the 2008 financial crisis, some active managers successfully navigated the downturn and achieved positive returns. But this requires exceptional skill and timing. Passive investing offers simplicity and peace of mind. By tracking an index, you avoid the stress of picking individual stocks and timing the market. Historical data shows that over the long term, the market tends to go up. Since 1926, the S&P 500 has returned an average of about 10% per year, despite numerous downturns. A blended approach can offer the best of both worlds. You might allocate a portion of your portfolio to active funds for potential high returns and another portion to passive funds for steady growth and low costs. This strategy can balance the risks and rewards of both approaches. Another tactic is to use active management in less efficient markets. These are markets where information is not as widely available or prices are not as transparent. For example, emerging markets or small-cap stocks might benefit from active management due to the potential for finding undervalued opportunities. Meanwhile, use passive investing for more efficient markets, like large-cap U.S. stocks. Here, it's tougher for active managers to gain an edge since information is readily available and prices reflect all known data. It's also worth considering factor investing. This involves targeting specific drivers of returns, such as value, momentum, or quality. Factor-based funds, sometimes called smart beta funds, combine elements of active and passive investing. They follow a rules-based strategy but focus on certain factors that can enhance returns. Chapter 5. Income Streams. Building a multi-layered revenue system. Creating a multi-layered revenue system in your investment portfolio is like constructing a financial safety net. It ensures you have income coming from various sources, providing stability and growth. The first layer to consider is dividends. Dividend-paying stocks offer a regular income stream and can be less volatile. According to J.P. Morgan, dividends have contributed to more than 40% of the total returns of the S&P 500 over the past 80 years. Real estate investments are another solid income layer. Rental properties can provide a steady cash flow. The National Council of Real Estate Investment Fiduciaries, NCREIF, reported that private real estate returned an average of 9.85% annually over the past 25 years. You can also invest in real estate investment trusts, REITs, which pay out at least 90% of their taxable income as dividends. Peer-to-peer lending is a newer but growing income source. Platforms like Lending Club and Prosper connect borrowers with investors, offering returns that often exceed traditional savings accounts. According to Lending Club, their investors have earned an average annual return of 5.06% since inception. Don't overlook fixed income securities like bonds. They provide regular interest payments and can stabilize your portfolio. U.S. Treasury bonds are considered one of the safest investments. Corporate bonds, while riskier, offer higher yields. The Barclays Aggregate Bond Index has averaged annual returns of about 5.5% since its inception. Preferred stocks can be a hybrid between bonds and common stocks. They offer fixed dividends and have a higher claim on assets than common stocks. During times of economic uncertainty, preferred stocks can be a reliable income source. According to a study by Nuveen, preferred securities have historically provided higher income than bonds with similar credit ratings. Annuities are another option for guaranteed income. They are insurance products that provide regular payments for life or a specified period. While they can be complex and come with fees, they offer peace of mind with a predictable income stream. A study by the American Council of Life Insurers, ACLI, found that annuities are especially beneficial for retirees, providing a steady income during retirement years. Consider international income sources as well. Investing in foreign dividend-paying stocks or global bonds can add diversity and increase potential income. According to Fidelity, International bonds have provided higher yields than U.S. bonds in recent years, offering an attractive addition to your portfolio. Remember to reinvest your income to benefit from compounding. Reinvested dividends can significantly boost your returns over time. A study by Hartford Funds showed that $10,000 invested in the S&P 500 in 1970 would have grown to $1.6 million by 2020 if dividends were reinvested, compared to just $430,000 without reinvestment. Balancing multiple income streams can protect you from market volatility. If one source underperforms, others can fill the gap. This approach not only stabilizes your income but also enhances growth potential.